Good afternoon, everybody, and thank you for joining us today. My name is Andrew Sykes, a Business Advisory Director with RSM, and I'll be your moderator today. As things are rapidly changing with the COVID-19 situation, we wanted to provide you with some insights into the government stimulus package, and in particular, the application of the JobKeeper payment scheme. We're going to have a look at an overview today of a few key concepts around this. We'll take you into employer eligibility and employee eligibility, interaction with other taxes, record keeping, risk management, and some of the next steps. We'll also allow a bit of time for Q&A. Presenting today, we have Sam Mohammad, Director Indirect Taxes with RSM, and assisting we have Will Laird and Tracy Dunn. Both will be answering your Q&As. You'll see on the bottom of your screen there is a Q&A box. If you can enter questions in there at any time, and one of our panel of experts will assist you with the answers. If we look at our COVID-19 response framework, this has been developed by RSM to provide guidance to businesses to help them make through this difficult time. Looking at the immediate things that we need to do, and then how we need to approach the longer term to repair our balance sheets and strengthen our businesses. Today, we'll be looking at the early part of the framework, and we'll be considering how we can access government stimulus to bolster cash flow and improve our chances of maintaining both employees and survivability of our businesses. This framework is available at the RSM Coronavirus Resource site, which is www.rsm.com.au/coronavirus. There's also reports that are available there that cover a lot of the detail that we're going to run through today, and you'll be able to access a full recording of the webinar. I'll hand it over to our presenter, Sam, who is going to take you through the key concepts and into the detail of the JobKeeper.
Thanks, Andrew. In terms of the overview of the JobKeeper program, it's fair to say that a lot has happened in a very short space of time. So I appreciate that there's a lot of people on the call who might already be familiar with the scheme, but it's still worthwhile providing a bit of a recap. The scheme itself is a $130 billion program designed to help employers subsidise the cost of retaining employees. But the second element to it, it's also designed to ensure that employees keep that connection to work, which will be vital once, I guess in the Prime Minister's words, we snap back into normal, or I guess whatever the new normal might look like. The program itself will be administered by the ATO and operated using the existing tax and single touch payroll systems. While the ATO is to be commended for the speed with which it's put out its guidance and made the application process available to businesses, it is fair to say that there's still a lot of unknowns and gaps in understanding. What we do know is that the JobKeeper program will run for a maximum of 6 months, and the payments from the government will be accessible for income tax purposes, but not subject to GST. In terms of eligibility, businesses and not-for-profits will have to show that they are carrying on a business and that their turnover has declined by a sufficient percentage relative to a prior period. Once you satisfy the eligibility criteria and once you enroll in the program, you're eligible for the rest of the program and you don't need to keep assessing. Once you're in, you're in. There is a two-part process. You enroll once for the program, and then every month you apply for payments for each eligible employee for each JobKeeper fortnight within that month. It's $1,500 per employee before tax each fortnight, and it's paid monthly in arrears to the employer. So there's a real question here for employers in terms of how they're going to fund the cash to make the necessary wage payments. This will be a critical and practical issue for employers, especially if the $1,500 minimum fortnightly payment to an employee is higher than what the usual wage is. Now, given this is intended to be a pass-through from government to employer and then ultimately to the employee, it goes without saying that employers cannot retain any of the $1,500 where we're talking about employees. It must be passed on to the employee or for their benefit in full, but it may not necessarily be in the form of cash, which is a point we will cover later in the session. A point which the ATO has clarified in recent days is that this is a one-in, all-in scheme, which means that if an employer elects to access the scheme, the employer must nominate all potentially eligible employees and cannot pick and choose which employees it will nominate. Finally, many of the rules for the JobKeeper program are designed around ensuring there's no windfall gain in terms of the employees who are already accessing government-funded wage subsidies. So there's no effective double dipping. So this could be in respect of paid parental leave or state workers' compensation payments. So while it's correct to say that the JobKeeper program is a 6-month scheme, it's probably more correct to say that it's actually a 13-fortnight program, because eligibility for each payment is based on a fortnightly basis. So the first fortnight starts on the 30th of March, and there are 2 JobKeeper fortnights per month, except for August, which has 3. Payments made are on a monthly basis in arrears on the 14th of the following month. So for instance, if you're looking at the month of August, you'd need to have paid by the 2nd of August to be eligible for fortnight 9, but you won't in fact receive the payments until the 14th of September. So this goes to that cash flow issue I was talking about. So on this next slide, what we wanted to do was really just to help clients visualize what the JobKeeper program might mean in terms of actual dollars coming into the door. So with one employee, what you're looking at over the life of the scheme is just under $20,000. But when you start extrapolating those numbers out, it can really add up. So for a business which has got 1,000 employees, you're looking at $19.5 million across the life of the scheme. Now, obviously, the assumption here is that the employer is eligible for the first fortnight all the way through to the last, and that every employee remains within the scheme from the start to the finish. But hopefully this gives you a better picture of the substantial amounts of money that we're talking about here being paid by the government, and the shortness of the time frame as well. Just to cover off some of the basics around employer eligibility. So fundamental to accessing the scheme is a business has to be an eligible entity, and it can qualify in one of 2 ways. Firstly, it can qualify through having paid employees, and presumably this will be the most common one, but not the only one. The second way that an employer can be eligible is if it has what's called business participation, which we'll come to in a couple of slides. On the other hand, ACNC registered charities are eligible for the scheme, but can only qualify through having an entitlement based on paid employees. Some of the other threshold requirements are set out on the slide. We won't go through all of them because many of them are self-explanatory, but I just wanted to flag a couple. So firstly, not only is there a requirement for the entity to be carrying on a business, but that business has to be in Australia. Similarly, for a not-for-profit, they must be carrying on their objectives in Australia. There's already a significant commentary in relation to what these terms mean, so I won't go through it, but it's important to consider this when you're looking at other types of companies such as investment and passive entities. Secondly, and one we will look at in a reasonable amount of detail, is the decline in turnover test. There will be a minimum 15, 30 or 50% decline in turnover needed for the business, which depends on the type of entity it is, as well as the turnover of the entity. And we'll also go through the 1 March conditions and some of the record keeping requirements later in this session. Now, looking at the entitlement based on paid employee, the table provides quite a lot of detail. And again, in the interest of time, we won't go through it all in a lot of detail, but I just wanted to flag a few things. You must meet the tests set out on the right-hand side of the table by the end of the relevant JobKeeper fortnight to be eligible for payment for an eligible employee. The flip side of that is if an entity fails to meet the tests at the relevant end of the fortnight, they're not eligible for payment for that employee for that fortnight, and then would have to look at it again the next fortnight. You must meet the wage condition test for each fortnight to be eligible for a JobKeeper for that employee. So essentially that wage condition is that the employer must pay the employee at least $1,500 per fortnight before tax to be eligible. This is a very black and white test, so anything less than $1,500, you get nothing. But once you reach or exceed that $1,500 for that employee for that fortnight, you become eligible. Finally, employers must elect to participate in the scheme through an online enrolment process, which most of you would be aware opened up on Monday. To be eligible for the first 2 fortnights in April, the enrolment forms must be completed by the 30th of April. As mentioned, there is a second way that an employer, not an ACNC registered charity, can be eligible for the scheme, and that's through what's called business participation. Really what this is designed for is for those businesses like sole traders and partnerships where the owner and the operator of the business may be self-employed as part of the business, but may not necessarily pay themselves a wage. As you'll see, most of the criteria is very similar to the one that we had for paid employees, other than the fact that what we're talking about here is a non-employee individual who's actively engaged in the business as opposed to an employee, and that again, not-for-profits aren't eligible for this payment. Just on the non-individual employee point, only one individual per entity can obtain this payment, and that individual cannot be an employee. The table on the slide provides the requirement for each entity type, and also that the individual must be 16 years or older, although it must be 18 years or older if it's a beneficiary of a trust. They must also be an Australian resident. Further, the individual cannot be a business participant for another entity and also cannot be an employee of another business. An interesting point with the JobKeeper program made in respect of a business participant is that the JobKeeper payment is made to the entity, but unlike where the payment for an employee is made to the employer and must be passed on to the employee, where it's paid in respect of business participation, it doesn't need to be passed through to the non-employee individual. Finally, there's also an active business integrity rule. So the requirements are set out in the slide there, but essentially the business can't be what the ATO calls a pop-up business, which has been created very recently, really for the purpose of obtaining job payments. Instead, a business must have had an ABN as of the 12th of March, and on or before that date, they must have lodged their 2019 tax return showing accessible business income, and lodged a BAS lodged after 1 July 2018 showing taxable GST-free or input tax suppliers. One of the most critical issues with the JobKeeper scheme is the decline in turnover threshold. If you don't meet this test, you're not eligible. More particularly, it's really important to understand what the tests are, how to apply them, when to apply them, who to apply them to, and finally, how to evidence them, as all of these are fundamental aspects of the test. To be honest, we could have had an entire webinar set aside for issues relating to how you calculate the decline in turnover test. So this will be reasonably high level. And I've also stuck with what's called the basic decline in turnover test. As many of you would be aware, the Commissioner is empowered to determine his own set of alternative tests where the application of the basic test that we're going to run through would be inappropriate or unfair. But as of right now, we're still waiting for that legislative instrument to be issued by the Commissioner. So we'll mention it briefly at the end of this, this section, but we won't go through it all. In the guidance notes, the Commissioner sets out a 5-step process for determining the basic decline in turnover test. And credit where it's due, it's actually a very good way of working through the test. So I'm going to stick with that 5-step process. Step 1 of the process is really to identify your turnover period in 2020, which is one of those 9 periods that are on the slide on the left-hand side. Now, these 9 periods are the 7 calendar months from March 2020 through to September 2020, plus also the 2 quarters of June and September 2020. As I mentioned, there are 13 JobKeeper fortnights spread across the next 6 months, starting from the 30th of March 2020. Since you can only be eligible to receive JobKeeper payments for a fortnight if you pass a decline in turnover test by the end of that fortnight, an entity wishing to be eligible for all 13 fortnights needs to have satisfied one of the 3 periods which starts on or before 1 April, and they're the three that I've highlighted in bold. So they're the month of March, the month of April, and the April to June 2020 quarter. One really important thing to note from the Commissioner's guideline is that the Commissioner has clarified that you don't have to choose a monthly test period if you have a monthly BAS, and vice versa. Just because you have a quarterly BAS doesn't mean you have to only be limited to one of those 2 quarterly test periods. Effectively, any entity can choose any period. So say, for instance, you have an entity that lodges quarterly BASs. It could choose a test period in the month of April 2020. While choosing a test period that doesn't match your natural GST reporting period it adds a layer of complexity in terms of your records may not actually be naturally prepared on a monthly or quarterly basis. This could be beneficial in circumstances where, as a quarterly BAS lodger, you might have had a terrible month of March 2020, but your June 2020 quarter isn't looking too bad. So by choosing a monthly test period of March 2020, you're potentially able to access the entirety of the JobKeeper scheme, whereas if you just had have stuck with your June 2020 quarter, you may not have been eligible. The last point to note from the slide is that once you've chosen your turnover test period, you have to identify what's called your relevant comparison period as step 2. Now that's really straightforward. It's effectively the same period in 2019. So that's the right-hand side of the table there. Looking at what you include in turnover for GST purposes, when you're looking at the turnover test period for 2020, other than March 2020, which is now already passed, where you're able to use actual figures for, all the turnover test periods are based on projected GST turnover for that period. So say you're wanting to test the period of April 2020, what do you include? You would include all of the value of the taxable supplies that you've made to date. So that's from the 1st of April through to the 22nd. You should have those figures already, but you also have to project forward for the next 8 days and work out what supplies, taxable supplies, are you likely to make between now and the end of the month. And the word likely here is really just a best estimate. It's, according to the Commissioner, it's on the balance of probabilities, what's the most likely thing that's going to happen between now and 30 April. So once you've added in your taxable supplies, you do the same for your GST-free supplies. Add in the supplies, the GST-free supplies you've already made, plus the value of the GST-free supplies that you think you will make between now and the end of the month. These are effectively the existing GST turnover rules. So there's nothing new in what I've just said, but there's a few modifications here. One is that if you are a member of a GST group, you have to actually add in the GST exclusive value of the supplies made or likely to be made in the period to other members of the group. This is an important one to note, as usually for GST purposes, supplies between members of a GST group are ignored and don't count as part of turnover. Also, if the entity that we're talking about is an ACNC registered charity or a deductible gift recipient, you need to add in the value of all of your gifts. Now, usually gifts are excluded from turnover since by definition, gifts are given for nothing and are not supplies for consideration. In case you're wondering why you have to add these back, there's a feeling that by including this, it will help charities satisfy the turnover test because the expectation is that donations will start to fall away. So if you can evidence the fact that those donations are starting to fall away, you will pass the test. On the right-hand side, you'll see what's excluded, and generally they will be your input tax supplies, such as interest and receipt of intercompany loans and any dealings in shares. Also, what's excluded are supplies for no consideration, supplies which are not made as part of an entity's enterprise. So these could be a sole trader making private use of their own vehicle. And two that are quite often overlooked but could be very relevant in this environment. So supplies of capital assets and supplies made as a consequence of substantially or permanently reducing the size of the enterprise. So on this last point, say you've got a business that operated 10 stores, but because of the downturn, the owner has to sell off one of those stores. What this exclusion does is it excludes from projected GST turnover the value of the sale of that one business or the assets that were contained within that one business that is being sold off. Again, this could make a very favourable difference to the turnover calculation. with the current turnover from the same period in 2019, it's essentially the same test, other than the fact that you're using historic numbers and there's no estimation or projections involved. Just a couple of points to flag on this part. The projected turnover test is partly or fully based on reasonable projections and forecast at the time the projections are made. These projections, as long as they were reasonable at the time they were made, they don't get reviewed with the benefit of hindsight. So that being said, you have to actually make sure that you document, or at least can evidence what those reasonable assumptions are. So this could be business plans, forecasts, management accounts, buyers' assumptions. Now, because of the modifications in the test and the fact that you can have a testing period, which is a quarter, notwithstanding that you're a monthly BASA lodger, your test periods won't actually match, or may not match, the BASAs that you've lodged. That's okay. What matters is the fact that you've documented the turnover calculations correctly. So it's really important for you to get your defence file right, so that if and when the commissioner were to come in and say, let's check to make sure that you've done the decline in turnover test correctly, you've got a work paper that you can show the commissioner. Finally, and this appears to be a bit of a double dip for those on a cash basis, the commissioner has stated that entities that account for GST on a cash basis of reporting can use either their existing cash basis to do their projected GST turnover, or alternatively, they can do it on an accruals basis. However, those who are already on an accruals basis must continue to use an accruals basis for their projected GST turnover. Moving on to the last couple of steps, these are generally going to be the easy and mechanical steps. So step 4 is you work out your aggregated turnover to determine which of the 15%, 30% or 50% decline in turnover you need. The definition of aggregated turnover refers to the ordinary income for income tax purposes of both the entity and its related or connected entities, such as subsidiary entities or parent companies. So you look at the ordinary business income for the entity and its related entities, and if that amount for either the prior income year or the current income year is or is likely to be over $1 billion, the decline in turnover between your 2020 period and your comparison 2019 period needs to be at least 50%. Otherwise, for all other entities, which I suspect will be the ones on the call, the required decline in turnover will need to be 30%. There is a special rate that applies to ACNC registered charities of 15%, though ACNC registered schools and universities are excluded from that 15% rate and otherwise need to satisfy the 30 or 50% as relevant. And finally, to step 5. Step 5 is to apply the decline in turnover to the required, your actual decline in turnover that you've calculated, and apply that against the required decline in turnover. So if it meets or exceeds it, then you're eligible for JobKeeper from the start of that period. What you'll see on the slide is an example I've extracted from the Commissioner's guidance. Now, without needing to go through it in any great detail, what it's trying to show is that the two companies, FluffyCo and PuppyCo, are connected entities, and therefore their aggregated turnover is the sum of those two individual turnovers, so the 950 plus the 100. So that takes them over the $1 billion threshold, and therefore they require a 50% decline in turnover. You'll see that PuppyCo has declined only by 10%, whereas FluffyCo has declined by 50%. So FluffyCo will be eligible for JobKeeper starting from May 2020, whereas PuppyCo would need to use an alternative period to be eligible. The last item I wanted to cover is the alternative test. Now, I did mention that we're still awaiting quite a lot of detail from the Commissioner as to exactly what this will apply to. The basic test, I guess, presumes that the entity in question was in existence this time last year, so that you do in fact have a 2019 comparison period. It also presumes that the entity which operates the business to the public is also the entity which employs the staff. Now, as we all know, that's not always the case for many groups, which typically have a single employer entity and then a separate service company where a separate business company, which is the one that provides all of the services to the public. So while the business entity may have suffered a decline in turnover due to its sales declining substantially, the employer entity still has the same revenue because its revenue is effectively a recharge of its employee expenses to the business entity, and that may not have changed or may not have declined by the required 30 or 50%. I understand the Treasury and ATO are still undertaking urgent consultation to work this out, but as of yet, we're still waiting to see some further guidance. You'll see in the example that an alternative test may also apply to, say, startups who weren't in business this time last year. And a potential option here is to use the average monthly income from the period from which they've been in business through to the start of the JobKeeper program in March, and then use that average as the comparison to compare to their projected GST turnover, say in April 2020. So in this case, what we're talking about is averaging the turnover from October 2019 through to March of 30,000, and then looking to compare that to the actual projected GST turnover of 15,000, which is a 50% decline, and therefore that's greater than the required decline, which is 30%. So they would then be eligible for JobKeeper. So just switching sides now away from the employer, and let's look at the employee eligibility. Again, this is a fundamental part of the JobKeeper scheme. As we've, after you've looked at your eligibility as an employer and you've met your decline in turnover test, the next step is to look at those employees who will be eligible. The basic tests for employee eligibility are determined as of 1 March 2020 and are that they needed to have been a full-time or part-time employee as of 1 March 2020, or a long-term casual and not a permanent employee of another employer. They need to have been at least 16 years of age, and they need to be an Australian resident and citizen, the holder of a permanent visa or a protected special category visa holder, or an Australian resident and the holder of a subclass 444 visa. The other requirements are that the employee needs to have been employed by you, the employer, at some time during the relevant JobKeeper fortnight, including those who may have been stood down or rehired. They also need to agree to be nominated by you and not be nominated by any other employer. And they must have also been paid the minimum $1,500 per fortnight that we've been talking about. Turning now to some of the issues that we've seen from our clients that they've been experiencing with the employee eligibility. There's obviously an age-old issue around determining residency, and there's the usual kind of vague and very fact-specific tax laws that you must apply. So if you do have any concerns around that, obviously seek some external advice. I understand there's also an additional layer of complexity for those who are on a subclass 444 visa, who would be from New Zealand and would otherwise obtain their visa as they arrive into Australia. The issue there is that they may not in fact be Australian residents. So I guess we're just not sure as to how many people may in fact be eligible under this element. The definition of long-term employee is taken to have its meaning in the Fair Work Act. However, that fails to really have regard to the fact that this definition itself is not overly clear. And so what we'd recommend is that any client who's struggling with this definition seek their own employment law advice, as it may not be obvious in every circumstance. Where an employee has one or more multiple employers, the employee can nominate any of their employers to be their eligible employer. The exception to that, though, is where you've got an employee who is a long-term casual for one employer, but a permanent employee for another employer. They must nominate their permanent employer. Finally, we've discussed previously that an employee must receive the minimum $1,500 per fortnight. However, it's important to note that $1,500 per fortnight can be satisfied through a range of means. So it obviously can be wages, it could be PAYG withholding, it could be fringe benefits, it could be salary sacrifice amounts, including salary sacrifice superannuation, but it can't be the actual super contribution itself. One final thing to note is that if an employee is ordinarily paid less than $1,500 per fortnight and must be topped up to get to the $1,500, the amount of the top up is not subject to superannuation. However, and to reiterate, their usual time earnings, say for instance, they usually get $1,000, that $1,000 would be subject to superannuation, but the top-up amount of $1,500 would not be. Turning briefly to how JobKeeper may interact with other employment tax obligations, as it currently stands, JobKeeper payments, when passed through to the employee, are likely to be considered taxable wages for state and territory payroll tax purposes. And that's purely just a function of how the current payroll tax law is written. It's not specifically in respect of JobKeeper. It's just simply because it's seen as remuneration for the services rendered by the employee. The exception to this at the moment, the singular exception to this at the moment, is Western Australia, which has already legislated an exemption for the first $1,500 that's paid to an eligible employee. South Australia has also announced by press release an exemption, but as yet it hasn't been legislated and we haven't seen the form of that legislation. We suspect it'll be similar to Western Australia, but we just obviously cannot guarantee that because we haven't seen the actual form of the law yet. Ideally, it would be great if the other states came to the party, but as of yet, there's been no formal announcements. Looking at workers' compensation premium, at this stage, there haven't been any formal announcements around what the treatment will be for JobKeeper payments that pass through employers. So as of right now, it looks as though those amounts would be considered as wages and would be subject to workers' compensation premium in each of the states and territories. What this all means is that JobKeeper payments passing through the employer are not at a neutral cost. There is in fact, or could in fact be, a real cost. We're talking potentially in the range of 5 to 6% just in terms of payroll tax and workers' comp on the pass-through of the payments of JobKeeper to employees. So again, it's important to just give some thought to whether the JobKeeper scheme is in fact right for you, or can you afford it? And it comes back to that cash flow issue that I mentioned at the start. To briefly cover off on the record keeping requirements, there are very broad integrity and anti-avoidance measures built into the law, which are really designed to capture anyone that's seeking to manipulate their tax affairs or their business affairs for the sole or dominant purpose of accessing the JobKeeper scheme. In addition, there are some significant and very hefty penalties and interest that may be payable if you're found to have entered into one of these sole or dominant purpose schemes. So I guess the very simple message, not just to companies and clients and businesses, but also to their advisors, is to really think through the logic and the business justification for doing anything along the lines that may be seen as allowing you to access the scheme that you may not have otherwise have done. So for instance, if you're holding back on your billing cycle, or if you're standing down your entirety of your workforce, notwithstanding that there may in fact be work available, really give some thought to why you're doing it and whether the sole or dominant purpose may be for JobKeeper purposes. Employers will have to manage the expectations of the public and employees if an employer chooses not to participate in the scheme, even if they may be eligible. Anecdotally, we've seen evidence that some small businesses are bearing the brunt of disgruntled employees simply because the small business may not have the cash flow to cover the fortnightly payments and can't bear the on-costs that are associated with JobKeeper that we've spoken about, particularly around payroll tax. Finally, there's a requirement to retain sufficient evidence and essentially a defence file to evidence a number of matters relating to JobKeeper payments, such as the turnover calculations and identifying eligible entities. In terms of next steps, the ATO itself has put out a lot of guidance around JobKeeper, but what you're seeing on the screen is the ATO's suggested step plan as it stood earlier this week. It's a pretty reasonable guide, so given I wanted to allow a reasonable amount of time for Q&A, I won't go through it, but it will be in the slide pack so you can read it at your leisure. I will note that the enrolment form is now live. There were a few bugs in the system on Monday, particularly around the business participation. The system wasn't allowing people to enter in employees as 0. I understand that that has been rectified. There were 1 or 2 other bugs that were present as of Monday, but again, I've been told that they have been rectified. The form itself is reasonably straightforward, so I won't go through it in any detail. The final slide I had is again one that you can take away and read through at your own pace. Really, if you're trying to access the scheme from day one, for the first 2 fortnights, you've got some very critical dates, particularly around the 30th of April. So obviously you need to have satisfied the wage condition, which is you must have made essentially $3,000 in payments to eligible employees by that date, and you needed to have completed and lodged your enrolment forms. That's really the end of the technical content. So I'm going to hand back now to Andrew, and I guess we can start to go through some of the Q&A that we've received, or if anyone else has any questions, feel free to use the Q&A function to ask them.
Thanks for that, Sam. So we'll start with our Q&A. As Sam said, we still have Q&A function still open if you want to send more through that come up. So first to you, Will, I'll ask you, can a business decide when to start taking part in the scheme, i.e. third fortnight, even if they qualify from the first?
Thanks, Andrew. Yes, it's a really good question. So the general rule of thumb is that you can enrol in the first fortnight that you become entitled to enrol, and there's an extension for the first 2 fortnights, given one's already passed, we're in the middle of the other one, giving you up until the 30th of April. However, if an employer is still working through whether or not they feel that they can enter the system, given the cash flow issues that might arise for them and having to fund it, they can certainly opt in at a later point in time.
Excellent. Thanks for that. And while you're there, we'll ask you as well. So this is an interaction with a pension. If wages are topped up to $1,500 per fortnight, do we know if this will affect the age pension?
So this would be someone that is receiving the age pension and might also be receiving some income. That's a really good question, and I haven't seen any guidance on that at all. I would assume that it could well create some problem unless there are amendments.
Okay, thank you. Sam, for the turnover test, do we need to include intercompany sales? For example, intercompany sales between Australian entity to US parent entity?
Short answer, yes. So what you've got to look at there, and this goes back to the ordinary GST rules, is what is the nature of that supply? So if they were within a GST group, ignore that. You look at it as if it was a standalone sale between an Australian related company to its US related company. Generally, that's going to be a GST free supply. So if it's a GST free supply, you would have to then include the value of that transaction in your turnover threshold.
All right, thank you. And while we're on the turnover test, once we satisfy the fall in turnover, do we need to satisfy the test in the following period? What happens if the sales is increasing, let's say in August 20, do we need to notify ATO to stop paying JobKeeper payment?
That's a really good question. There's a couple of parts to it. So one is, say for instance, you estimated, so if we go back to the turnover calculation, say for instance you used April as your base, and you estimated you were going to fall by say 32%, for instance. On that basis, you made a JobKeeper claim. As the law currently stands, and the way we think it will be administered is, even if you fall below, and it turns out your actual figures may come in at you only declined by 28%, as long as the estimate was done reasonably at the time, you would still be eligible for the fortnights in respect of the month that you've done. But once you're in the scheme, you're actually eligible for the entirety of the scheme. So if for instance, in April, you did in fact decline by 35%, and then you go to do your May-BAS and you've only declined by 5%, you're still eligible. So once you're in, even if your decline doesn't maintain that 30 or 50% threshold all the way through. So you still need to provide to the Commissioner by the 7th of each, or the 7th of the next month, what your estimated figures might be, but there's no clawback, and you're not withdrawn from the scheme if you don't maintain a decline all the way through.
So it'd be fair to say enrol once, but report monthly.
Correct.
All right. So, Will, I'll ask you a question. What if a business is not registered for STP? What do you have to do?
Yeah, sure. So we did sort of move across it fairly quickly, but on the enrolment form that was on the screen earlier, there were actually two parts to it. First of all was those who will be using STP and those that cannot use STP. So they'll actually have just a little bit more time. Yeah, that's the one. You'll see there that in step 2, it talks about a business that doesn't have STP enabled software, but they do have to have less than 40 employees. So if they got more than 40 employees, there is obviously an expectation you're on STP. But if you're under that, then there is actually going to be a process where you can use either the business portal or the tax agent's portal to enter various details about the employees.
Excellent, thank you. And while I've got you, Will, I have an employee on unpaid parental leave. Is she eligible for JobKeeper?
So the only exclusion around parental leave is if you're on government-funded paid parental leave. So this is the case where people are participating in the government-funded paid parental leave. If it's employer-funded paid parental leave, or they're simply on unpaid leave, not getting any government funding for it, then they'll still be eligible.
Excellent, thank you. Sam, another question on GST turnover. Is there a minimum turnover requirement? An entity having 16K revenue last year and only achieved 7K till now, it won't be getting any more in the next 3 or 4 months. Will that still be eligible?
Yeah, so there's no minimum quantum of turnover. What the tests are looking at is the decline. So as a percentage, essentially 7/16. So on that basis, you would be eligible. So as long as you're as long as you meet the decline in turnover, the actual numbers don't really matter.
All right, and with that turnover and the tests, there has been a number of questions about the alternative tests, and I've got one here. Are we able to register for JobKeeper before the alternative test has been made available, basing on the monthly average example?
It's a very good question. One I think we're all grappling with there's a couple of parts to it. One is there's been some informal guidance which has been issued similar to the example that I've extracted, which was a startup which wasn't in existence back in 2019, where you might be able to use average turnover since it's been in existence. I guess given the shortness of the timeframes that we're dealing with, an approach, which is not an unreasonable approach, is to proceed on the basis that you will be eligible. So go ahead and collect your nomination forms. But obviously you need to see the form of the alternative test before you go ahead and make your claim, because technically you can't in fact make the claim until you fall within that alternative test. And so without the actual guidance itself, it is difficult. We expect it will be any day now. I don't know, Tracy, if you're on the call, whether you've had any further updates, but as of today, I haven't seen it.
No, nothing yet. Still waiting.
The second example, which is that service entity example, is very definitely a live example. And again, you have some clients who are proceeding on the basis that they will be eligible. So they're going ahead and doing their turnover calculations based on a corporate group decline in turnover, not necessarily an individual entity turnover, but obviously can't make any claims until the alternative test itself is finalised. Others are kind of sitting and waiting until that alternative test is issued.
Okay, thank you. And I'll put this out to whoever on the panel wants to answer it. Have a casual being paid $1,000 a fortnight now. I could start paying her $1,500 a fortnight just for the purposes of getting access to the JobKeeper program. The comment on that is that surely that is not the intention of the program, or the question on that. Perhaps it'd be good just to run through that employees who are paid under the $1,500 and what needs to happen with them.
I can jump in there, Andrew. It's a great question, and it has now been clarified by the ATO that the intent of the policy is that it is one in, all in. which means that unfortunately for those employers who have long-term casuals who are eligible and they're being paid, in this example, $1,000 a fortnight, the employer will be required to pay them $1,500 a fortnight if they register for the program. So that's a consideration for business, and unfortunately if the employer is eligible for JobKeeper and doesn't pay an eligible employee because they normally receive less than $1,500 a fortnight, they may face civil penalties under the Fair Work Act for not complying with minimum condition.
Okay, Tracy, and if you could just clarify for me, the additional $500 per fortnight, will the employer have to pay superannuation guarantee on that?
The intention is that they won't have to pay super guarantee, but we're still waiting for the legislation to be changed. So at the moment, employers are in a difficult situation because the existing law would require super to be paid on the top up, but the intention is that that additional amount won't be subject to super. But until we have further guidance, can't provide much more assistance, unfortunately.
Thank you very much. So we have a good question here in relation to turnover. So for Sam, if I could ask you, if you have an existing business, then in October 19 purchased another business in the same industry, increasing the turnover significantly on the purchase of the new business, would this be considered for the alternative test, or is it likely to be?
It's likely to be. So that is an example that has been put out there informally as one where the basic rules would unfairly apply. So in that example, but for the acquisitions that may have been made in the intervening period of late 2019, potentially they would have satisfied the basic decline in turnover, but due to their M&A activities, they don't. So they won't pass the basic decline in turnover test that we've gone through. But because of the unfairness of it, it's likely to be one which will be captured by the alternative test. So the guidance at this stage is the alternative test is likely to cover startups. It's likely to cover this M&A type scenario. Outside of that, we're not sure just how far it'll go.
Okay, thank you for that. And Tracy, another question on an employee pay. So if an employee gets paid $3,000 per fortnight usually, and the employee is an eligible employee, does a company only pay super on $1,500 and the JobKeeper of $1,500 is not covered by super?
No, unfortunately, the employer is required to pay super on the full $3,000 per fortnight. So super guarantee, compulsory super rules continue to apply to normal wages that are earned by the employee. It's only where the employer is required to pay an additional amount over and above what the employee would normally be paid because of the fact that they have to meet that $1,500 per fortnight minimum condition.
All right, thank you. And Will, one of the last questions that we've got about eligibility. What about a business that's been trading as an active business since October 2018 and has not yet lodged their 2019 company tax return? They're on a deferred lodgement program with a tax agent up to 15 May 2020 and previously had less than 75K in turnover, so wasn't required to lodge or register for GST and lodge a BAS.
Yeah, good, Andrew. So there's a few points to clarify in that. So this requirement about having to have a 2019 tax return lodged or report a BAS is only relevant to the business participation one. So this is where you can have one business participant that might be entitled to it. So that's not a requirement for the general employer one. There are some 1 March conditions for the general employer one. But in the case, let's say it is the business participant scenario, in that particular case, the Commissioner is very aware of those types of instances where, and the fact that there's been extensions given for bushfire, for lodgements and so forth. So I would think there is the possibility they might be entitled so long as they meet all the 1 March conditions. That is that the person that's going to be the business participant was actively engaged in the business on 1 March and also in the relevant fortnights. But we will need some more guidance from the Commissioner to come out to work out the processes there to be able to tick the boxes.
Terrific, thank you. And we've got time for one last question. To Tracy, I have a casual employee that has been on our books for 2 years, but didn't work for a period of 6 months early 2019. Is there a requirement to be continuously met for continuous monthly employment?
That's a good question. And it may actually be a question that needs to be referred to an employment lawyer, because the guidance that we have around regular and systemic for the purposes of determining whether a casual is a long-term casual comes from the Fair Work Act, and the information that we have is that employee needs to be on the books for that 12-month period, that they need to be available when the employer has work available for them. So it might be a bit of a complicated process of going back through records and getting some more guidance from an employment lawyer as to whether a casual would fit into the definition under those circumstances.
Excellent, thank you panel, and thank you for everyone who has attended. I'll just let you know that if you have further queries at the RSM coronavirus website, our resource site, we do have a facility there where you can enter a query and one of our team will come back to the response with a response. So that's rsm.com.au/coronavirus. Thanks, that's all we've got time for. We'll be running additional webinars on related topics, and you can find the details of these as well as the materials we've discussed today at that resource site. So thank you all for joining us today.